Page Industries, the powerhouse behind Jockey in India, was once the epitome of a coffee can stock, dominant, predictable, and a favorite for long-term investors seeking steady, reliable returns. For years, it set the benchmark for consistency and resilience in the Indian stock market, earning the trust of those who value stability over speculation. But as of early 2026, its relentless growth has noticeably slowed, leaving investors to wonder, are we witnessing just a temporary pause in its journey? Or is this the beginning of a new, more subdued era for the company? The stark contrast between Jockey's iconic brand presence and the company's recent modest returns has sparked debate and demands a much deeper look into what's really happening beneath the surface. At Marcellus, we believe in cutting through the noise. Our focus remains firmly on the fundamentals and the long-term cash flow generation potential of businesses, rather than being swayed by short-term market sentiment or fleeting headlines. Our goal is clear: to rigorously assess whether Page's core strengths, such as its distribution network and brand loyalty, remain intact, and to determine if it still stands out as a compelling long-term investment opportunity in today's evolving market. The central question we must answer is this: has Page Industries matured into a steady compounder? And does its current valuation truly reflect the potential for sustainable future growth? Or is caution now warranted? Page Industries' strength lies in its exclusive, long-term Jockey license, giving it full control over manufacturing, marketing, and distribution. Jockey's brand power allows for premium pricing, built on decades of advertising and customer focus. Unlike many apparel firms, Page manufactures much of its product in-house, ensuring quality and supply chain control. Its vast distribution network, distributors, exclusive outlets, and large format stores makes Jockey omnipresent in India. Exclusive outlets reinforce the brand and are tough for competitors to replicate. Innerwear is a necessity, not a luxury, providing stable, recurring demand. This combination of brand control and necessity creates a business model built for longevity. Page's empire is founded on both stability and aspiration. From 2022 to 2025, Page's growth slowed from 25 to 30% to high single digits, reflecting its maturity and larger base. Yet, its capital allocation remains stellar, with returns on capital employed consistently above 40%. The business is capital light, funding growth through internal accruals and generating strong free cash flow. Page's balance sheet is robust, with negligible debt and disciplined financial management. This financial strength allows continued investment in brand and distribution, even in tough times. While explosive returns are unlikely to repeat, the franchise's quality is undiminished. The key question now: what is a fair price for this slower but still high-quality growth? Investors must recalibrate expectations for the next phase. Page's biggest growth lever is the under-penetrated women's innerwear segment, a gradual multi-year opportunity. Athleisure is another growth area, with Jockey's comfort and brand equity well suited to this trend. The Speedo license adds exposure to India's growing fitness market. E-commerce and direct-to-consumer channels are rising, letting Page engage customers and gather valuable data. While online sales are still small, they're growing fast and are vital for future relevance. International expansion, especially in the Gulf, offers diversification but remains a long-term, peripheral play. The core story is still India, with steady, incremental growth. Investors should expect evolution, not revolution. Page's future is about disciplined expansion, not explosive leaps. Page's premium positioning is a double-edged sword. While it shines in prosperous times, it becomes especially vulnerable when consumers start tightening their budgets and discretionary spending drops. The very strength that sets Page apart can quickly turn into a weakness during downturns as shoppers gravitate toward more affordable alternatives. Recent years have shown that volume growth can slow dramatically during periods of economic stress, with even loyal customers sometimes pulling back on purchases or delaying upgrades. Valuation risk is real. Page has long traded at lofty multiples, reflecting high expectations. But as growth slows, these premium valuations become much harder to justify, and investor sentiment can shift quickly. Multiple contraction could drag returns, even if the underlying business continues to perform well, making it a silent but significant threat for shareholders. The Jockey license is a foundation for Page's business model, but any renewal issues, however unlikely, would be existential and could fundamentally alter the company's prospects overnight. Competition is evolving rapidly, with digital-first brands aggressively targeting niche segments and younger consumers who are more willing to experiment with new labels and online platforms. While barriers to scale remain high, Page must keep innovating and investing in its brand to defend its turf and stay ahead of emerging rivals. The company's future depends on its ability to adapt to new threats, respond to shifting consumer preferences, and maintain relevance in a fast-changing market. These risks are manageable with the right strategy, but they must be respected and actively monitored to avoid unpleasant surprises. Quality alone isn't enough. Vigilance, adaptability, and a proactive approach are essential for long-term success. Valuing Page Industries is about common sense. Future returns depend on earnings growth and the price you pay. With growth now likely at 12 to 15% per year, returns will mirror this if you buy at a fair multiple. But if the price-to-earnings ratio contracts from, say, 60x to 40x, returns could be dragged down to single digits. The risk isn't business quality, but overpaying for it. Buying at a reasonable multiple, ideally 35 to 40x, gives the best chance of returns matching business growth. Patience and discipline on entry price are crucial. For Page, quality is a given. Price determines your outcome. Don't chase, wait for value. In 2026, Page Industries stands as a testament to enduring business quality, boasting a dominant brand, deeply integrated manufacturing, and a fortress-like balance sheet that has weathered many cycles. Its era of explosive, breakneck growth is now behind it. Page has transitioned into a mature, steady compounder, delivering consistent performance year after year. Investors must recalibrate their expectations. Now, a 12 or 15% annual return is realistic, rather than the extraordinary 30% returns seen in the past decade. The key variable for future returns is no longer just business quality, but the price you pay to enter. Even the best business can disappoint investors if bought at too high a valuation, regardless of its underlying strength. Today, the margin of safety lies in valuation, not just in business fundamentals. Price discipline is crucial. Wait patiently for moments of market pessimism or temporary setbacks. These are the opportunities to buy quality at a discount. Page remains a core holding for patient long-term investors, provided you enter at the right price and with a long-term mindset. Always separate the business from the stock. Page is an A-plus business, but it's only a buy when the valuation makes sense. For discerning investors, the real edge lies in buying quality businesses at a reasonable price and then holding on through cycles with patience and conviction.